Welcome everybody, Doug McKay, antiwallstreetguy.com on the 21st of October 2011. The overall trend remains long. We closed basically at the highs today on the S&P with an increase in volume. We closed at 1238. Yesterday, intraday, we traded below with EU news, below 1200 at a certain time. We were at 1197. Today we got above this resistance here, and more importantly the area of resistance of 1228 to close again at 1238. Where do we think we're going? Probably somewhere between 1250 and 1300 on the S&P cash. We do not think, based on what we see technically, that this year we will be getting beyond the 1350 1360 level in the cash. We believe that this is a bounce, and then we think we're either going to trade sideways or go lower. If you're just looking at these videos for the first time, this was a key reversal day here on October 4th. More or less the completion of a fifth wave down with a sideways fourth that basically was with us for anywhere from 8 to 10 weeks. And then we blasted off here. We did not get long or call the trend long until we got above this downward sloping trend line, and that I believe was another Monday. That was Monday the 10th. For the managed accounts, we were in Monday morning here, and then we also added 50% more on Tuesday, this past Tuesday here. Wednesday was a little bit of a pullback. Yesterday we were down, and then we finished up. And then today we broke out on higher volume. What we did do yesterday in the managed accounts is we did begin to hedge some of our long position going into the weekend, simply due to the EU news, not because of the trend at all. But I really didn't feel comfortable going into the weekend all long. So that's what we did. Would I do it again in hindsight? Yeah, I probably would. What we hedged with at that time, or what we have hedged with is the QID, which is double short the NASDAQ 100. This is the reverse of the Qs. If we look at the Qs, we can see that the Qs, even though they're above this trend line and it's a decent looking chart, they have yet to break out. And they are also the lowest performer today in terms of percentages. Now, if we get above 58.50 on the Qs, we will remove the hedge that we put in yesterday. If we don't get above 58.50, this area of resistance, then we will remain with the QID hedge. All right, but the overall trend, again, as long as of the morning of the 10th of October, once we got above this trend line, and again, for our purposes, we think possibly somewhere between 1250, 1300 is the extent of this run. The 200-day, you guys, I believe is right around 1260 on the S&P cash. All right, let's take a look at gold. And we had a position in gold in the managed accounts once we got above this area of resistance. This looked kind of tired. We anticipated, if you remember the video the last week or so, that we were going to potentially come up and fill these upside gaps around the 170 area, maybe 173, provided we broke out of this base. We did break out of the base, but then GLD looked more tired. So what we did is we sold half the position towards the close, towards the highs on Tuesday. And then we started to hedge on Wednesday. So we kind of have a 1-for-1 hedge with GLD and GLL. Just a smidge up today on the difference between the two. The next step, since we did fill this gap, is we will put a stop on both the GLD and the short gold GLL. And whichever one runs, hopefully it's going to continue to run in that particular direction. I'd be very surprised if this 155 holds on GLD. I think we're probably going down to 150, but we'll see. We'll give it the benefit of the doubt. And over the weekend, I'll put stops on both the GLD and the GL. Now, why didn't we just dump the GLD? Number one, on this day, it still did not break these lows. In other words, when we let go of it on Tuesday, I just thought that it was going to come down. Based on the chart, it looked like it was going to come down. It did. We did not dump it yesterday, meaning GLD, even though it broke this area of support. It still held this, but also it gapped lower. So we thought because it gapped lower, it may come back up and fill that gap. Because it gapped lower, it may come back and fill that gap. So that's the reason we kept both the GLD and the GLL through the day. All right. But I think gold's going lower at this time. But we'll give it again the benefit of the doubt and put a stop on both of these. Let's take a look at the SPY. Maybe we can possibly see some gaps here. As you guys probably know, the S&P cash does not show gaps, but the SPY does. We do have a little bit of a gap here. We anticipate that that will be filled. That's not to say that we won't go higher, but we could come back down and fill this early next week. And then also, if we take a look at McDonald's, this was a still chart that we had put up on the 16th. And we were waiting for it to get above this area of resistance. And we were also waiting for it to get above this horizontal line. Nice earnings today. It popped higher. Do I like the stock? Yes. Do I like the volume? Yes. Breaking out, obviously it broke out to new highs, up 3.72% today. What I would probably do is I would put a half a position on here, and then I would put the other half on once it comes back down and fills this gap. All right. At some point, it's going to come back down. The odds are highly probable and fill this gap, but it may run away from us first. So we'll see. All right, you guys, that's pretty much it. You know what? I'll tell you what. Let's take a look at bonds. We did exit, for those individuals that had it in the managed accounts, the short bond position. I believe we exited it right here. You know, fundamentally, I think interest rates are going to go lower, which is good for treasuries. But this is a good-looking chart. To me, this tells me that rates are going higher, and the long end is going to get hit. When I look at a chart of TLT, this to me was kind of a head fake. This was, let's suck them in one more time and go up and surpass these tops, and then let's take it down. And then once we broke this trend line, that was also time to look over at the TBT. So we may be looking for an entry back into the TBT. But as it stands right now, our focus, at least in the managed accounts, is on the VTI, the Vanguard Total Market Index. Again, we bought on this day, and then we added here, and we started to hedge yesterday. We will remove that hedge if the Qs, because the Qs, shorting the Qs is our hedge, the NASDAQ 100, if we were to get above this area basically of 58.50. Again, gold, we're going to play one way or another next week. We'll put tight stops on both sides of it. Hopefully there'll be no whipsaw. One will run in one direction or the other. We'll see if McDonald's fills the gap. And that's it, you guys. The overall trend is long. The way we have it as of the 10th, Monday of October. And again, I'd be very surprised. Anything can happen. We'll let the charts dictate our moves. If we were to get through this high of 1350, 1360 on the cash this year. Again, we're thinking somewhere between 1250 and 1300, and then we're going to come back down. All right, you guys, that's it. Doug McKay, antiwallstreetguy.com. As always, thank you for visiting the blog and the radio show. We'll see you next week. Thanks.